Absolutely, and Ron Devari's here for an instant audit from NewOak Capital. A good person to talk to. Good morning, Ron, because we've talked about commercial real estate with you a number of times when you've been on the program. So let's talk about it from a couple of different angles. Number one, are you as worried as the Federal Reserve? And then maybe we can get into some of the investing angles. But what do you make of this morning's article?
Absolutely. I think the commercial real estate is really one area that the systematic risk is coming back again. Yeah. I think it's going to be very unlike the residential credit. This is going to be a very slow, as you know, the income is a lagging indicator. The majority of the income on income properties is going to slowly, obviously, come down. The cap rates have gone up, which means that the property values have come down. But a lot of the commercial real estate actually can meet their debt service coverage, meaning that they can still make payments. One of the biggest issues is the refinancing issue, which, as these loans are typically 5 to 10-year loans, when they come to a balloon date, that's the date that they have to actually refi, then there's negotiation between the borrower and the lender, and often enough the lender does not want to put the borrower in a technical default. Right. And so that's what we're seeing, that a lot of the loans are in a technical default, but I think at the end of the day, with patience, we were going to get through this.
Well, it's shocking, though, to see some of the analysis that the Wall Street Journal did, saying that if they look at these banks that they were looking at, about 800 of them, that these banks had 38 cents in reserves set aside for every dollar in bad loans. That doesn't seem like enough. Not enough.
No, it's not enough, but also you have to look at their write-downs. The banks are going to be very slow because they don't have the adequate capital to really replace and take the reserves. So as they go out and raise capital, then they're going to be able to face the reality. It's more of a...
And you think they can do that? Because we hear that the commercial real estate problem is really going to hit after Christmas, when these retailers are going to find out of whether or not they can actually make their rents going into the first half of 2010.
Absolutely. I think again, it's going to be a slow, painful process for the next couple of years as the leases come due. The retailers are not going to be able to get out of leases unless they file bankruptcy. And as we have seen, many of them are actually not in a bad position on a long-term basis. Right. So they're going to be able to take pain for a short term.
So it's like the air's coming out of a bubble as opposed to one that's just bursting. No, and it takes a long time
it's not like a housing market in that sense.
So it's different than residential that way. Now, your job is to try to find investing opportunities in this. And the last time you were on, you're saying, hey, listen, we've seen this coming for a long time. People have talked about it ad nauseum, and it's maybe not going to be quite as bad as the worst case prognosticators are making it out to be. Is that still the way that you feel, and how do you take advantage of that?
Absolutely. If you look at commercial mortgage-backed securities, these are actually the top 25% of the market. You know, the more institutional loans that have been put in these securities that then put into essentially the CMO style bonds, and they're actually invested by many institutions in these securities. Right. As you know, there is a TALF program. The Federal Reserve is essentially giving 5 to 6 times loan and for investors to actually buy these. We think the top of the stack, that means the super senior part of these structures, are actually very suitable for investors to look at because you have essentially a lot of protection. You'll be able to weather the downturn.
The government's backing you up, and they're kind of mispriced to the downside a little bit.
Well, they're backing your loans. They're not backing the security. Just be very careful. So you still have a potential to lose all your money. Right. But for the most part, you're going to get your coupon for the first 5 years. And then whether you're going to get the principal depends whether we're going to reach the waterfall of 30% loss in the pools as a whole. Right. And 30% loss in these pools would be a number that no professional would have thought we would ever get. So I think that the general consensus is it's going to be between 10%, 5 to 10% cum loss. So we should really brace
still bad for the economy, but you can still take advantage as an investor. All right, Ron, thanks. We'll talk more about it. Ron Devari from NewOak with us this morning.
We're going to move. Interesting to have that story, Ron Devari. He's back with us from CEO of NewOak Capital. Interesting to have that story right behind the other one on lending. And a lack of loans or, refinancing, anything being able to hit the market. So then you have Costco coming out with, on the surface, looks Okay.
Okay, yes.
How are they hanging in there? How do you make sense of the news together like that?
Well, as it was reported, obviously the sales were down, but the actual profit was actually beat the street's forecast. So companies are actually being very careful about their bottom line. They're cutting costs at the same time as they're maneuvering through. And this also ties back to your commercial real estate. Because a lot of Costco's are actually leasing spaces in malls, and these malls are essentially financed by the banks or in the commercial mortgage-backed securities. So I think for the public to really understand, we are obviously maneuvering a downturn. And the good thing about it is that it's actually not out of control. We are seeing the downturn in the earnings, we're seeing the downturn in sales, but the retailers are actually able to manage through that, keep the stores open, and hopefully support our banks.
Is there any concern that the downward quote-unquote spiral becomes out of control sometime next year? I mean, to go back again to commercial real estate and everything else, is there something on your radar screen that says, well, if this happens, then it could be a lot worse and more difficult to manage?
I think the most important thing is that the regulators and the banking authorities are becoming very aware that the commercial real estate refinance wave has to be taken care of.
So they have to do something.
They have to do something, because you have to convince. As you notice, the banks are not they don't have any appetite to lend on commercial real estate.
So what if the government buys commercial mortgage-backed securities? What are they going to do here?
I think that buying the commercial mortgage-backed securities is not going to get people to lend. You need to actually get people willing to lend, which means that you really need to support at the end of the day new lending, and that is really completely stopped, which is really what the worrisome fact about all this. It's not us being maneuvered through the income. There will be income in these properties. The question is how much debt load can they afford, and who is willing to actually roll over these loans. Yeah. So that's something that we watch over 2010, 11, 12. As a matter of fact, the peak is going to be in 2013. So we think there is a bit of a maneuverability between the lenders and the existing borrowers, but ultimately we need to get this market back on its feet again.
What's your favorite thing to buy at Costco?
Toys.
Right? There's so many different things.
Maybe.
Yeah. You ever go to Costco? There's a lot of great stuff.
I used to have a membership, but I don't have it anymore. You know who's a big Costco guy? Charles Payne.
Oh,
Get
we'll
him in
have to
here.
ask him next
He's
hour.
a big Costco guy. He always has. He's well. Anyway, we'll have him talk about it next hour. Thank you, Ron.
Thank you so much.
Thanks, Ron.
Good to see you. All right, fast food doing well.